Bismillahirrahmanirrahim. Wassalatu wassalamu ala Sayyidina Muhammadin ashrafil anbiya'i wal mursalin wa ala alihi wa sahbihi ajma'in. Rabbi shrah li sadri wa yassir li amri wa hlul 'uqdatam min lisani yafqahu qawli. Allahumma rabbi zidni 'ilma warzuqni fahma. So we'll start our first lesson with the first chapter, which is the introduction to the corporate finance. So there are three main areas under this chapter, which is function and objective of the corporate finance. Subtopic is on what is the definition of the corporate finance, objective of the corporate finance, and how to create value of a firm, and how to maximize the shareholders' wealth. Yeah? The second area is the stakeholder objective and possible conflicts. And the last part is the agency problem and control of the corporations. So maybe for today, I just can cover with you on the first part, functions and objective of corporate finance. So this will be the recorded video part 1, and part 2 will be the stakeholder and agency problems. Okay, so the first thing first is on the responsibilities of the corporation. Okay, so the main goal of a company or the main goal of a firm is to maximize the value of a firm. Maximize the value of a firm for the interest of various groups. Okay, maximize the value of a firm for the interest of various groups of stakeholders. All right, so in a company there are so many stakeholders. Okay, stakeholders, that is the next subtopics. The stakeholders of the company consists of customer, supplier, okay, customer, supplier, shareholder, bondholder, okay, inclusive to the stakeholder also the government, okay, the government. Then the society also can be part of the stakeholders. So we want to maximize the value of firm. For example, shareholder, they want to have the share price appreciation. Maximize the value means when you, let's say shareholder A, shareholder A buy stock of company ABC company, buy stock or shares, okay, buy stock or shares, company ABC, at price RM 1.5. So when shareholders A wants to sell the stock, of course, shareholders A want to sell at a higher value, which is, let's say, 1.8, so that shareholders A can have capital gain. So when we can give the shareholders A capital gain, extra value, that means the firm's already successful in maximize the value of firm when the price increase. Okay, and another one, if the company able to give dividend to the shareholder, and so that means the company are able to increase or maximize the value of firm. Because to enable the company to pay dividend, the company must have upper profit or earnings. So this is the rules and regulations by the Companies Act. Before company wants to announce dividend, the company needs to close its financial statements and make sure that there is a profit. So the net income available to the ordinary shareholders can only be divided to the or distributed to the shareholders via dividend. If there is no net income available, the company usually the company is not allowed to distribute dividend. However, if the company on the previous years have the accumulated profit or have a retained profit or have a share premium, the company may do so. Okay. Okay, so the responsibilities of a corporation also, the company needs to efficient and effectively manage investments made to reward the stakeholders with appropriate returns. So in order to increase the value of firm, the management, the team of management consists of the directors and the key management people, directors, which is the board of directors. So this is the head of the management, plus the management team, which is the key personnel of the company, which is the managing directors, general managers, CEO, CFO, CAO, must have a good administration on efficiency and effectively manage all the investment means when they want to choose the investments or project they want to invest, they need to have very critical selections on the investments, on the types of project they want to invest. They cannot just put the money in the project without any scrutinizations or evaluation on the risk assessment on the project's returns. Okay, corporation or company also needs to govern and manage activities of the firm related to financial decision making. So good financial decision making is very important because this is relay the information to the investors and the shareholders. Information to the shareholders and the investors, potential shareholders, potential investors, because these shareholders, investors, they don't have the opportunity to involve in the business day-to-day business operations. So they just rely on information from the companies throughout the decisions making made by the directors and the management team. So the directors and management teams are responsible on these capital investment and budgeting decisions, asset management decisions, working capital expenditure decisions, financing decisions, how to get the source of financing decisions, how to invest. So this one is more, the three here is more on investment decisions. Investment decisions. And also make risk assessment on the business and financial risk. So when I slideshow like this, I cannot see the timer. So that's why sometimes I can to see 10. So I think better for me to do like this one. Okay, the next thing is functions and objective of corporate finance. So what is the corporate finance? So this is to explain to you on the definitions on the corporate finance. So corporate finance surrounding by the three different questions addresses the following areas, which is number one is what kind of long-term asset should the firm invest. So this one relates to this number one, capital investment and budgeting decisions. So this one, long-term assets, so this is the capital investment. Okay, so I think no problem for you to see the slides like this because I need this one, the menu, and I need to look at the timing. So if I just do it like this, menu tu tak ada, so it's susah. And to change from one slides to slides also is quite fast if I show slide like this. Okay, so continue to this. What kind of long-term asset? Long-term assets, this is the non-current assets. Non-current assets, or also known as the fixed assets. So the company invests fixed assets via capital investment and capital budgeting decisions. This you have learned before in your financial management when you are doing investment appraisal. So remember last time you are doing investment appraisals, techniques for capital budgeting techniques, when you assess the project to invest in buying equipments of a company, machines, you are using the net present value, you are using the internal rate of return, you are using the accounting rate of return, payback period. Then also you are comparing whether on the financing is leasing, finance lease or operating lease, kan? Then I think ada a few different techniques lagi ya, to make assessment on the capital investment and budgeting decisions. So the second one is the how can the firm raise financing for the required capital expenditure? So what kind of long-term assets? This is the investment. Invest. So you want to invest. So you want to invest means what assets you want to buy. Yeah, for example, when you graduated, you graduated, you get jobs. Then after that, of course, you want to buy something. Let's say you want to buy a car, you want to buy a house. That is your investment. So the next question is how to finance the investment. So this is financing. How to finance the investors. So how to get money to pay for your investments. How can the firm raise financing means how can the firm get money. Get money, or in finance term, they call it as source of financing. Okay, source of financing. This one also you have learned before in your financial management when you learn on the financing approach, financing approach, where you have, see, remember, you have the aggressive approach. What else? You have the conservative approach. You have the hedging approach, isn't it? Hedging approach is the balance between the long-term and short-term financing. Conservative approach is more on the long-term financing. Aggressive approach is more on the short-term financing. So that is the financing. Where you get money, what is the source of financing in order to pay for your investments. Okay, then the third one, how the firm managing the short-term operating cash flow for day-to-day business operation. So this is more on your working capital investment, as well as working capital financing. Okay? For example, you are buying your stocks, or you are buying your closing stocks, opening stocks, what else? Terms lain daripada stocks, inventory. Inventory, yeah. US is using words inventory, UK is using word stocks. So let's say you want to invest in buying stocks, in buying inventory. For example, now is Hari Raya. So those bakers who are doing the bakery products, cakes and cookies, of course they want to, they need flour. They need flour as a main ingredient, raw material to produce cookies and cakes. So this flour is the inventory. So they need to invest in buying flour. Jadi, this is a working capital investment. And how you finance your working capital investment ini. Okay, another things, if you already produce a product, so the product is let's say tadi cake and cookies. Cake and cookies, this is your product, and then some of the customers may wants to buy using a credit terms. That means not cash. Non-cash means credit sale. So when credit sale, when you have a customer who want to have a credit sales where the customer will pay later in next 30 days, so this is your investment on accounts receivable or debtors. Accounts receivable or debtors. So you not get the money yet, but you already produce the financing for this inventory and account receivable. You need to think. Okay, so this is the three areas that surrounding circulating on the corporate finance: the assets and the working capital investment, that is on the asset sides, and on the we can say on the debit side. On the credit side is your financing side usually. So financing side. So focus on the three capital or important issues, which is the capital budgeting, the assets, then how to finance of that capital budgeting, and how to finance your working capital, how you manage your short-term operating cash flow. Okay, so that these three areas in it actually form your balance sheet. as I mentioned here, if last time we call it as a balance sheet, the old schools, we call it as the balance sheet. Now we call it as the statement of financial positions. So this is the debit, this is the credit. Okay, so the debit side is actually your assets, your non-current assets, your current asset. Non-current assets is your capital. Apa tadi? Capital budgeting. So this is your capital budgeting investment. Current asset, this is your working capital. Okay, working capital. So these two form your assets. Okay, so then, so this is form your investment in assets. Investment in assets. So this is your asset. Credit. So credit represents usually your financing. Financing. Okay, so financing is used to invest the asset. So credit side is actually, this one is your liabilities. Liabilities. Sorry, my handwriting is not very good. Okay, so credit side is your liabilities, where you have the long-term loan to finance your asset, and short-term loan or your current liability. Okay, so these two, so this is the first address study. Okay, financing here, the second area, and the third one, working capital, the third area. So that form your financial positions of the company. Jadi both investment and financing decision form the financial positions, or we call it as the balance sheet model. So the investment consists of your net current asset, which is non-current assets, which is your capital budgeting. This one, capital budgeting, and the net working capital, which is your current assets, then current liabilities. Okay, next, so this form as the total value of the firm's asset, which is the value of investment, and that value of firm's asset will form as the value of financial claims. Okay, remember on the first slide, study sector stakeholders. So these stakeholders also, we can call it as the claimants. Claimants mean those parties that can have a financial claims. Okay, financial claims. Financial claims on what? Financial claims on the firm's asset. Jadi when you invest, you have the asset, non-current asset and current asset. So that makes that form the value of firm's asset. And this firm's asset can be the value of the financial claims by the firm's claimant. In case there's anything happen, your company winding up or liquidation, close business, close shops. Okay, this party who are invested in the company via the equity, the debt, they can have claims on your firm's asset. This party, we call it as the firm's claimants. Okay, so this party usually finance your investment via equities and debts. So the long-term financing consists of capital market, shareholders, ordinary shares, preference shares, or debt like the bonds, like the debentures, long-term loan, or short-term financing, current liability. And these form the capital structure of the firm. Jadi yang ini, tadi saya kata tadi, dekat balance sheet ini, you have equity, you have liability. You have equity. Equity kat sini, ordinary share capital, preference share capital. Then you have liability, which is your debentures, you have bond. Jadi yang ini equity, ini liability, ini consider is your debt kat sini. Is your debt. So equity plus debt, this form your capital structure of the firm. So this capital structure will be one of your topic nanti. So shareholder equity represents the difference between the value of asset and the debt of the firm. Jadi sebelah sini adalah assets. Okay. Sebelah sini. So asset tolak liability is your equity lah. Itu maksudnya. Shareholders equity represent the difference between So the difference between asset and liability is your equity. So shareholders' claim on the value of firms is the residual amount that remains after the debt holders and creditors are paid. So when company is in the winding up process or liquidation, the company will sell or dispose all of the assets or divest, kalau invest kita beli, jual divestment. So divest, dispose, sell of the assets, and the assets is used to pay the debtors first. Not debtors, debt holders. Debt holders and debtors is different. Debtors is your account receivable asset. Debt holders is your liability. Your creditors is debt holders. So usually the ranking, this one is referred to the ranking of priority when payment is made on surplus of asset. Surplus of asset or payment. Jadi yang pertama akan terima secured creditors. So mortgage debtors, mortgage debentures, kemudian creditors. Yang ketiga, preference shareholders. Yang keempat, the last one, ordinary shareholders. So you can see equity shareholders claim is the residual. Residual means lebihan or maknanya surplus. If there is any balance, then the assets will be paid to the shareholders after all the creditors and debtors, debt holders, not debtors, debt holders are being paid. Okay, so this one, function and objective of corporate finance. So financial positions of a firm, tadi, as I mentioned, it makes the balance sheet model where it makes the investment of a company and as well as the liability of the company. So the total on the credit sides or on the my right hand side, this one is the total value of equities, debt and equities. Okay, so dia macam ni lah. Ni balance sheet lah. Okay, so this one is the equity and debt and equity. This one is asset. So represents by the long-term liability, shareholders' equity, and the other side is current asset, fixed asset. Yeah. So that is the first thing. What is the corporate finance functions and objective? So the second thing is the objective of the corporate finance. The first thing first here, responsibilities is to maximize the value of firm. So in order to maximize the value of firm, the company need to maximize the profit, maximize the shareholders' wealth. So profit maximization is usually short-term goal. So the long-term goal is the shareholders' wealth maximization. So profit is subset to the shareholders' wealth maximization. So you can see here the circle. So the big circle here is the shareholders' wealth. Inside the big circle, there is a small circles like the profit, EPS, market share, reduction in cost. So all that inclusive the profit, that is the short-term goal, which is part of the shareholders' wealth maximization. So in the long run, profit maximization may not be appropriate because of this profit maximization does not consider on the uncertainty, risk factors, dividend policy, time of returns, and the risk-return trade-off. So what is this? What is the meaning of this? You need to read textbook, chapter 1, page 5. Okay, profit maximization basically not appropriate for long term because does not consider risk and uncertainty. Meaning that this profit maximization fails to recognize risk and uncertainty associated with a certain project. Shareholders, on the other hand, are very interested in the level of risk, and maximizing a profit may be achieved by raising the risk to acceptable levels, because we see that high risk, high return kan. Jadi if the company wants to venture into high risk project, shareholders are expecting to have the higher returns, but profit maximization does not recognize that. Okay, dividend policy. So shareholders are interested how much they will receive as a dividend, especially for the dividend gainers, dividend gain investors. So the retained profits can be increased by reducing the dividend payout ratio. So means that if the company decide to use their retained profit as a future investments for expansion project or for venture into project, of course they have to reduce the dividend payout policy, dividend payout ratio, or the company may not paying dividend at all because they want to use that profit for reinvestment. Jadi this is not for the best interest of the shareholders who are expecting the dividend, especially for the dividend gainers. So timing of returns means that this profit maximization has this advantage because it does not have or it does not consider the timing of returns. For example, like the increase in the short-term profit maybe is doing at the expense of the long-term profit. For example, sometimes company wants to reduce cost of research and development, R&D cost. So R&D cost, maybe the output, the outcome, the results will not get in the short term. The results from the research and development may comes in the long period. So if, let's say, the company wants to shortcut or wants to cut costs on the R&D, so that will be at the expense of the long-term profits, because that R&D, which the company is doing, let's say R&D on the product, maybe the product later in the future can bring a lot of revenue to the business. But since the company wants to cut costs on R&D, company will not have up-to-date products. Jadi that will, on the short-term period, the cut costs on the R&D benefit the company. They can reduce the R&D and increase the profit. But on the long term, on the long run, there is a dangerous or a risk to the company if they don't keep up to date with the customer acceptance by cut cost the R&D, because they do not know what is the customer's acceptance or what is the customer's preference if they don't have the survey or feedback or doing prototype on their products. Okay, that is the timing of returns. Increase the short-term profit at the expense of the long-term profit. So it will have a serious consequence in the long-term business profit. Risk-return trade-off means the profit maximization ignores the risk-return trade-off, which they may increase the reported profits by selecting the high-risk project. As we know that high risk is a high return. So even though high risk is associated with a high return, however, the risk may shrink the returns available to the shareholders if the projects turn out to be bad. So that's why risk assessment is very important, because we want to make sure that the high risk is materialized by the high return. But somehow it can happen oppositely, where we expect to have the high return because of the high risk, but the risk turn to be maybe the company can't afford to bear the risk that makes the projects turn out to be bad. Jadi that will see the strategy as a poor earnings quality, and from that relay negative signals to the shareholders, and they may pull out or sell their shares, so makes the share price drop. So that's why the shareholders need to go for the shareholders' wealth maximization. So I think for this one, shareholders' wealth maximizations, I will continue continue later to give way for the students to dismiss class and welcome students 4E to continue class. So now we will continue on this function and objective of corporate finance on the second objective, which is the shareholders' wealth maximization. So as I mentioned, shareholders' wealth maximization is a big circle, which profit maximization is part and parcel of the shareholders' wealth maximization. So to get or to maximize the shareholders' wealth, the company, the firm, not only need to maximize profit, but also need to maximize the other factors like maximize the earnings per share, likes to maximize the growth of the business, reduction in the cost, expanding the market share, and many other things. Okay, so what is the shareholders' wealth maximization? So this is actually creating value per share for the existing stock price and increase dividends paid. So as mentioned earlier, shareholders are expecting that there is a share appreciation in their share price. Okay, another one is dividend. So there are two types of investors or shareholders. Types of investors usually. For the share appreciation, we call it this type of investor is the capital gain investors. Capital gain investors. Okay, for the dividend, shareholders are expecting dividend. We call it as the dividend gain investors. Okay, dividend gain investors. So that's why you are learning dividend policy. Yeah. Okay, capital gain investors, they are looking at the share appreciation. So when the share price is higher, from what they bought the shares, when they compare the shares that they buy and the share that they sell, they get a capital gain that we consider that the firm is creating value or able to maximize the shareholders' wealth. Okay, for example, shareholder X pula buy stocks in JK company. Okay, so when the shareholder X buy, it is at a price 31.5, and JK company, the board directors and the team managements able to invest in a good project, and the good earnings already influence or the investors or influence the stock market to make the share price in the stock market higher. Jadi from 1.5, now the stock price increased to 1.8. So there is a 0.30 cent. Ini we call it as the capital gain. So when the investors or shareholders able to get the capital gain from the share appreciation, which is from 1.5 to 1.8, we say that the company, the firms, the board of directors, and the team managements are able to increase the value or creating value per share, able to increase the shareholders' wealth maximization. Okay, so however, it is not an easy task as the managers do not directly control the firm's stock price in the stock market. So the buying and selling shares, the price here is referred to the price traded at the stock market. Okay, price traded at a stock market. This is not the price represent the real value, or we call it as the intrinsic value of the firm. It is actually represents the price traded at stock market, at the equity market. The price trading. It depends on the supply and demand. If that stock high demand means many investors wishes to buy that stock, that means that will increase the price because high demand. Then, if the stocks is less demand, or the existing investors sell the stocks, that means they increase the supply. Supply will reduce the price of the stock. Jadi the price of the stock at the stock market actually depends on the volume, comes from the supply and demand from the investors. Later on, I will show you the trading platform, Bursa Marketplace or Bursa Malaysia, how the price is determined. So you can see that the price is always change based on the demand and supply from the investors, speculators who are doing bid and offer for the price ataupun volume of shares at the stock market. Okay, so managers who are the management, represent the management, managers or board of directors who represent the management in the company, do not control the firm stock price in the stock market. Sebab stock market tadi saya kata apa, it depends on the demand and supply of the stock. So whatever companies is doing, is it affect the stock price? Affect ke tidak? So how the managers may affect the value per share? So these questions you may get the answer in the textbook juga, yeah, in the textbook. So which is in the page 6 in the textbook. Under the creating value, dekat situ. So most firms are owned by the shareholders and were established to make money for the shareholders. So primary goal must be to maximize the shareholders' wealth. So maximizing shareholders' wealth usually is maximizing the firm's total value per share as well as dividends. There's another investors who are dividend gainers. Jadi for the dividend gainers, these types of investors are expecting that the company able to pay higher dividend. So jadi higher dividend depends on the earnings. Depends on the earnings. Jadi for the managers or directors, they have the responsibility to make selection of the investment that give higher returns. Jadi kat sini, even though it is questions, or the statement says that managers do not directly control the firm's stock price, as the stock price is influenced by the demand and supply of the investors or trading at the stock market. But whatever managers did, especially on the decisions making on the capital budgeting, investment decisions making on financing, decisions making on the working capital management, do effect, because the decisions making will relay the information to the investors who are doing trading at the stock market. Jadi kalau the investors, the managers is doing a good decisions, and that decisions brings good earnings to the business, that sounds a positive signals to the investors, and the investors, maybe the investors influence to buy the shares, and ultimately the price of the stock will higher. Okay, so that is the relationship, how the managers action, how the managers decisions making at the corporate level, at the firm's level, do affect the value per share at the stock market. Maknanya it is affected by the actions of managers, especially on decisions making. So that's why managers, if their decisions or their actions will affect or influence the price of the stock market, they need to do declaration, they need to do announcement, they need to do press conference, they need to inform to Bursa Malaysia. Yeah, kalau tak, if not, they are being charged on the illegal offenses, or we call it as the insider trading. Okay, jadi they need to inform the investors by way of doing declaration or announcement or press conference to the Bursa Malaysia, to the investors. That is the requirement by the listing requirement. Okay, so as I mentioned, decisions making of the firms, which represented by the board of directors and the management team, is very important. So here, financial manager's primary goal is to increase the value of the firm, and finally to maximize the shareholders' wealth by making decision which selecting value creating project. That means if they want to venture into projects or investment, they must be very selective. First thing first is the risk return trade-off. They need to do or select, or on the basis of risk assessment must be done. So value is created if the cash paid to shareholders and bondholders is greater than a cash raised. Cash paid, that means this, when the shareholders want to sell, shareholders are received that cash. So it should be higher, greater than, for example, like this. So when the shareholders want to sell, should be higher than when the shareholders buy. So the shareholders buy, there is a cash raise in the firm. When shareholders buy, company will get cash. When shareholders buy, sell, so shareholders are being paid. Okay, so in other words, company needs to invest in a project or select projects that only give the positive net present value. Okay, invest in positive net present value project. So that's why you learn before in the investment appraisal. So it's very important to make assessment, appraisal of the project, and to make sure that the projects will give the positive NPV. Only invest in a positive NPV project. That to invest in a project, you need financing. That comes the financing decisions. So these financing decisions is need to have a smart investment decision, smart financing decisions. Okay, then this is the other things that I say is a sub factors to the big factors. So the big circle is the maximizing shareholders' wealth. That is this one. The big circles is the shareholders' wealth. So what is the component in the small circles ataupun sub points to the shareholders' wealth? This one lah. So the main goal is to maximize the shareholders' wealth. So to reach the maximization, to maximize the shareholders' wealth, company need to do in the short run, maximize sales, minimize costs, maximize profit, expanding market share, maximize the market share. Okay, expanding the market share means if that product is produced locally and market locally, company try to expand it overseas market, try to find a new market. So, and if the market share is only for teenagers, maybe the company can expand the market share to the adults. Yeah, adults have more purchasing power than the teenagers. Macam handphone kan, handphone now is not only for the adults but also for the teenagers also. Jadi expanding the targeted group, expanding the geographical on the market share and maximize that market share. So try to beat the competitors, to cut ataupun to eat the competitors punya market share. For example, like Proton and Pro2 on the local car passenger. So Pro2 versus Proton. So you can see last time a local car passenger market. So last time Proton acquired 80% of the local car. So when Pro2 is actively doing its research and development, where the new features or lifting on the accessories is being researched out or is being improved in the Pro2 cars, the launch of the Arus and so on, the new lifting of Myvi dan sebagainya, it increased the local car passengers. So last time is 20%, but now I think Pro2 already overtake the market share of Proton. So I think now is 60%, Pro2 40%. So you can see that 40% local car passenger market shrink in the Proton and is being eat by the Pro2. Nak kata dicuri tu tak sedap lah kan, negative words kan. So means that Pro2 successfully take the market share Proton on the local car passenger. So now Pro2 is the leading in the local car passenger market. So that's how to maximize the market share. Okay, then have a smart investment financing decision, increase the earnings per share, increase the growth, increase the dividend per share, avoid financial distress and bankruptcy. So this one relates to the smart financing decision. Smart financing decision. So smart financing decisions can help the company to avoid financial distress. Financial distress ni basically when the company does not have enough money to meet the obligation, to meet or to service the debt, to pay the interest, to pay the principal. So if the company having financial distress, unable to make payment, interest and principal, it will expose to the bankruptcy. So directors and the management need to avoid these matters from happen. Okay, last is the corporate governance. Corporate governance means takbir urus. So make sure that the company has systems, rules, regulation, principle, procedures embedded in the operations of the company, so that the operations of the company is in a systematic way. The operations are efficiently managed and efficiently managed. So good corporate governance is very important to avoid from misappropriation of asset happens, to avoid from the bribes, corruptions, wastage of resources as well. So management must act in accordance with the shareholders' best interest by making decisions that increase the value of the stocks. So all these things are the points or sub-points that can help the firm to increase the value of firms, or another word is maximize the shareholders' wealth. So I think for the first part, introduction to the corporate finance. Okay, we introduction to this corporate finance will stop at this hour. So we'll continue on the introduction to corporate finance for part 2. With that, thank you.